Each year, the IRS announces the maximum amount that an HSA account holder can contribute to his or her health savings account. But what happens if somebody only has an HSA for part of the year? Well, let's start with what we know. If an individual is eligible for the entire calendar year, January 1st to December 31st, then he or she may contribute the full contribution maximum depending on his or her age and coverage type. In the year that a person turns 55, they are eligible to make the full catch-up contribution regardless of when his or her birthday falls during the year, as long as he or she has qualified coverage for the whole year. So that additional $1,000 does not need to be prorated based on when the birthday is. If, on the other hand, HSA eligibility ends before December 1st, then there are some special rules. If someone loses or drops their HSA qualified coverage before the last month of the tax year, which of course is December 1st for most people, they will be able to make a pro rata contribution based on the actual months of coverage. Any excess contributions and earnings on those contributions must be reported as taxable income, and they are subject to a 6% penalty for every year those funds remain in the account. The good news is that excess contributions can be withdrawn prior to the tax filing deadline, which is April 15th, with no penalty. So an example might help. Let's say that on January 1st, 2019, Bob elects single HSA qualified coverage through his employer. He has that coverage January through May, but on May 31st, Bob loses his job and his coverage terminates. He does not elect COBRA. Instead, he signs up for his wife's non-HSA qualified health plan, so he is no longer eligible to contribute to an HSA. Because Bob's HSA qualified coverage ends before December 1st, he must prorate his contribution based on the actual months of coverage. The way he does this is he divides his single HSA contribution maximum of $3,500 in 2019 by 12 to get the monthly amount of $291.67. Because he was covered for 5 months, he can contribute 5 times that $291.67 for a total of $1,458.33. If Bob had started the year by contributing more than $1,458.33, then he will need to remove or withdraw that excess contribution no later than April 15th of the next year to avoid paying taxes plus the 6% penalty on that excess contribution. Now, there is another rule that says if an individual is eligible on the first day of December, then he or she can take advantage of what's called the full contribution or last month rule. Basically, that account holder is treated as having whatever level of coverage is in effect on December 1st for the entire year. So, for example, if the individual has family coverage on December 1st, then he or she can contribute up to the maximum amount for family coverage, even if the account holder switched from self-only coverage to family coverage during the year, or maybe didn't become HSA eligible until later in the year. Another example would be helpful. Let's say that on August 1st, 2019, Susie signs up for single HSA qualified coverage. She has that coverage for August and September, but then on October 1st, she adds her husband Gary to her health plan after he loses his coverage through his employer. Because Susie is covered on December 1st and because she has family coverage at that time, she's able to make the full $7,000 family contribution to her HSA for 2019, even though she only had HSA qualified coverage for 5 months of the year and only had family coverage for 3 months. So if we look at the prorated amount, we work it the same way. So the prorated amount, the monthly amount for single coverage, if you divide it by 12, is $291.67. If you take the $7,000 family contribution and divide it by 12, that's $583.33. She had single coverage for 2 months and family coverage for 3 months. That adds up to a prorated amount of $2,333. However, Susie is able to contribute the full $7,000 using the last month rule because she had family coverage on December 1st. Now, there is a requirement that Susie remain HSA qualified for the entire next calendar year. So if she takes advantage of the rule in 2019, she has to remain HSA eligible for all of 2020. 2020 is referred to as a testing period. If she loses her eligibility during 2020, then any amount that she contributed above the prorated amount of $2,333.33 in 2019 will be treated as taxable income in the year she fails the testing period. So in 2020, she'll report any excess contribution as taxable income, plus she'll pay a 10% penalty on that excess contribution. For people who contribute more than that pro rata amount during using their the HSA contribution last month rule, then the testing period requires them again to remain HSA qualified through the end of the following calendar year. To meet the test, it's only necessary to maintain HSA qualified coverage, and coverage can be either self-only or family coverage. Again, failure to meet the testing period means that a portion of the amount that was contributed must be included in the individual's gross income and will be subject to a 10% excise tax.